The U.S. Federal Reserve surprised many by cutting interest rates by 50 basis points. This significant move sent ripples throughout the global financial system. The Fed aims to stimulate the American economy. This move has implications for investors, businesses, and consumers alike. Analysts are divided on whether this rate cut is a sign of things to come. Some believe it's a preemptive measure to avert a recession. Others view it as a necessary response to already slowing economic growth. The Fed's decision has sparked intense debate among economists and policymakers. Some argue that it will provide a much-needed boost to the economy. Others worry that it could lead to inflation. The impact of this rate cut will unfold in the months to come. Only time will tell if the Fed made the right call. What is certain is that this decision will have far-reaching consequences. The Federal Reserve's decision to cut interest rates was driven by a confluence of factors. Chief among these was the concern over slowing economic growth. Indicators such as sluggish GDP growth and weakening consumer spending, the Fed's move aims to inject life into a faltering economy. Another major factor was the persistent threat of inflation. The Fed expressed concern over its potential resurgence. The rate cut is intended to stimulate economic activity. The Fed is walking a tightrope. It aims to balance growth with price stability. The Federal Reserve's decision to cut interest rates sent immediate shockwaves through U.S. markets. The stock market, often seen as a barometer of economic sentiment, reacted positively. The Dow Jones Industrial Average and the S&P 500 both saw significant gains. Investors interpreted the rate cut as a sign of confidence in the economy. This confidence led to a surge in stock buying. The bond market, however, told a slightly different story. Bond yields, which move inversely to prices, fell sharply after the announcement. This drop indicates that investors are anticipating lower interest rates for a longer period. It suggests a belief that the Fed is committed to supporting the economy. The US dollar also weakened against other major currencies. A weaker dollar makes US exports more competitive. However, it also makes imports more expensive. Overall, the initial market reaction to the Fed's rate cut was generally positive. The true impact of this decision, however, will take time to fully materialize. The Federal Reserve's decision to cut interest rates had immediate repercussions across the globe. As the world's largest economy, the U.S. exerts a significant gravitational pull on the global financial system. The rate cut sent ripples through international markets. It prompted responses from central banks and policymakers worldwide. In Europe, the European Central Bank, ECB, had already signaled its intention to ease monetary policy. The Fed's move added further pressure on the ECB to follow suit. The Eurozone economy has been grappling with sluggish growth and the threat of deflation. Emerging markets, which are particularly sensitive to changes in global interest rates, also felt the impact. The rate cut made U.S. assets less attractive to foreign investors seeking higher returns. This could lead to capital outflows from emerging markets. These outflows would put downward pressure on their currencies and asset prices. The interconnectedness of the global economy means that the Fed's decision will have far-reaching consequences. It underscores the importance of international cooperation. Section 5, Gold Rush, Precious Metals Shine Brighter. The price of gold surged to a 6-year high following the Federal Reserve's decision to cut interest rates. Gold, often seen as a safe haven asset, tends to benefit from economic uncertainty and lower interest rates. When interest rates decline, the opportunity cost of holding gold, which doesn't yield interest, decreases. This makes gold more attractive to investors. Silver, another precious metal often seen as a safe haven, also experienced a significant price increase. The rise in silver prices is linked to both its safe haven appeal and its industrial uses. A weaker dollar, often associated with lower interest rates, makes commodities like silver cheaper for buyers using other currencies. The surge in gold and silver prices reflects the heightened level of uncertainty in the global economy. Investors are seeking assets that are perceived as safe havens during times of economic turbulence. Section 6, the dollar's dilemma. Will it rise or fall? The US dollar, the world's reserve currency, faced downward pressure following the Federal Reserve's interest rate cut. A lower interest rate differential makes US assets less attractive to foreign investors. This can lead to a decrease in demand for the dollar. However, the dollar's trajectory is not always straightforward. Other factors can counteract the effect of lower interest rates. If the Fed's rate cut stimulates the U.S. economy, it could lead to stronger growth. This could potentially boost the dollar in the long run. The dollar often acts as a safe haven currency during global uncertainty. The future direction of the dollar depends on a complex interplay of factors. Section 7. Emerging markets. Navigating the new interest rate landscape. Emerging markets face a mixed bag of opportunities and challenges in the wake of the Federal Reserve's interest rate cut. On the one hand, lower U.S. interest rates can make borrowing cheaper for emerging market economies. This can be particularly beneficial for those with high levels of dollar-denominated debt. On the other hand, lower U.S. interest rates can also lead to capital outflows from emerging markets. Investors may pull money out of emerging markets in search of higher returns elsewhere. This can put downward pressure on emerging market currencies and asset prices, potentially destabilizing their economies. The impact of the Fed's rate cut on individual emerging markets will vary depending on their specific economic fundamentals. Countries with strong economic growth, low inflation, and sound fiscal policies are likely to weather the storm better than those with weaker fundamentals. Section 8. Egypt on my mind. A closer look at the Nile economy. Egypt, a prominent emerging market economy, is closely watching the implications of the U.S. interest rate cut. The Egyptian economy is heavily reliant on foreign investment, particularly in its debt market. Lower U.S. interest rates could make Egyptian debt less attractive to foreign investors, potentially leading to capital outflows and upward pressure on interest rates. The Egyptian pound, which has been relatively stable in recent years, could also come under pressure if investors lose confidence in the economy. A weaker pound could make imports more expensive, potentially fueling inflation. However, Egypt also stands to benefit from the potential for increased global growth spurred by lower interest rates in developed economies. As a major exporter of goods and services, Egypt could see increased demand for its products if global growth picks up. Section 9. Investing in uncertain times, strategies for a shifting landscape. The Federal Reserve's interest rate cut has created uncertainty for investors, but it also presents opportunities. With interest rates likely to remain lower for longer, investors need to adjust their strategies. One approach is to seek out investments that perform well in a low interest rate environment. Dividend-paying stocks, real estate, and precious metals are some asset classes that traditionally benefit from lower rates. Another strategy is to diversify across different asset classes and geographies. Diversification can help mitigate risk by spreading investments across various assets that are not perfectly correlated. This means that if one asset class performs poorly, others may perform well, cushioning the overall impact. Section 10. The road ahead, potential risks and rewards. The global economy stands at a crossroads. The Federal Reserve's decision to cut interest rates is a significant development. It injects uncertainty into the outlook. While lower interest rates can stimulate economic activity, they also carry potential risks. One risk is that the rate cut could lead to excessive inflation. If economic growth accelerates too quickly, it could push up prices, eroding purchasing power and potentially destabilizing the economy. Another risk is that the rate cut could fuel asset bubbles. Lower interest rates can make it cheaper to borrow money, potentially leading to excessive speculation and unsustainable asset price increases. If these bubbles burst, it could have severe consequences for the financial system and the broader economy. Despite these risks, there are also potential rewards. Lower interest rates could provide a much-needed boost to the global economy, which has been showing signs of slowing. Section 11. Conclusion. A new chapter in the global financial story. The Federal Reserve's decision to cut interest rates has ushered in a new chapter in the global financial story. This move, driven by concerns over slowing economic growth and global uncertainty, has sent ripples through financial markets and economies worldwide. The impact of this rate cut is still unfolding. Its consequences will reverberate for years to come. While it presents potential benefits such as lower borrowing costs and a potential boost to economic growth, it also carries risks, including the possibility of inflation, asset bubbles, and unintended consequences for emerging markets. As the global economy navigates this new landscape, collaboration and careful policymaking will be paramount. The interconnectedness of the global financial system necessitates a coordinated approach. Central banks, governments, and international institutions must work together to manage risks, promote stability, and ensure that the benefits of this monetary policy shift are shared broadly.